Well, hello and welcome everyone to the Trading Coaches Playbook for Friday. This is Brandon Wendell with you, and I'll be your guide hosting you for the next roughly an hour as we take a look at the markets. And the topic for today is trading the tops. So trying to figure out what we can do when we're at all-time highs when it comes to these markets. And yeah, so that's what we're going to do. And before we get started, actually, just need to remind everybody that we're not broker dealers or investment advisors. We're going to look at the information and the markets from an educational standpoint. I'm not telling you to buy, sell, or hold anything in particular or giving any personalized recommendations. All markets do involve risk of loss, and this is always a situation. No matter what we do, we can never eliminate the risk. We just try to minimize it and manage it as best we can. And we are also not subject to trading restrictions. So I and others could have a position in security or initiate one at any time. So welcome, everyone. And yeah, good morning, Helen. Good morning, Stephen. Good morning, Kevin. Good morning, everyone. Welcome. Basically, yeah, we've been looking at the markets and, oops, where am I here? Got so many things open. There we go. This is our program for our members dashboard for the various programs that I work with and host. And good morning, Jennifer. Good morning, Brenda. Welcome as well. The E-mini think tank is the one that probably deals with what we're talking about the most. And basically with the E-mini think tank, we get together 3 days a week and look at the active markets, mostly in futures, obviously with the name E-mini. And there's additionally with the live sessions, excuse me, there's also educational material that I put out there. You can see we've got recordings of the live classes, but there's a lot of bonus videos with education that I'm actually redoing as well and freshening up. And with all those pieces of education, there's actually documentation that goes with it and supports it. So that's kind of cool. Anyway, I digress. We are here to kind of discuss what the heck are we supposed to do when we're breaking out to all-time highs like this. Let me go ahead and remove some drawings. There we go. Clean charts are always best to start with. And thank you, Jennifer. She said she's been using the SPX trade. It's a program called the SPX cash flow. And that actually is one that is dealing with this as well. Oops, wrong page again. I go back, and you see my other program. We're trading the SPX with 0 DTE options on a daily basis. And of course, with the all-time highs, that becomes a bit of an issue as well. But basically, that's a little bit different where we don't have as many live classes. We get together for Q&A sessions, but basically, I send out SMS texts every day looking at the ideas in the markets. You can see I send out supply and demand zone alerts just to let you know what's going on. And then possible idea opportunities. Yesterday, we had an iron condor, and I cut off the message a little bit there, but there was also a bull put spread. And they worked out pretty well. You can see that all the options expired yesterday for a profit. And yeah, kind of what I was talking about with the, S&P going to new highs right here. I follow the SPX religiously, and you'll see I have notes here saying fib projections. Well, that's one of the tools that we might be able to use to help us when we're reaching out to all-time highs, because we usually won't have any overhead supply. You can see I do have a couple supply zones left, 5-minute and 15-minute for intraday trading. And typically when I do this, I'm dealing with multiple time frames when I trade. And I've mentioned this in my courses in much more detail, but when it comes to trading, I want to focus on at least 3 different time frames. My lowest time frame, I call it the zone time frame. That's the lowest. And that's where I find my entries and targets and stops. Basically, I'm finding what we call supply and demand zones, and I'm trying to find where prices are going to move between, where's going to be the likely high, where's going to be the likely low. And as I said, we're having some difficulty now as we're getting to all-time highs, while we did earlier last week. But basically, to figure out which direction to trade those zones, I look at my intermediate, or what I call my trend time frame. And again, that's the intermediate time frame, if you will. And that tells me the direction to trade. So as long as that trend is intact, I typically want to trade in the direction of the dominant trend, because that's going to give you the best opportunities. The moves are usually larger than when you trade against the trend, and they're higher probability. That's what we want when it comes to trading. We're never going to be right 100% of the time. All we could hope for is finding the highest probability and look for trades that kind of fit into that high probability and offer us relatively limited risk compared to the rewards that we're potentially going to get. And then the last is my perspective time frame, because trends don't go on forever. And that's the highest time frame. And that signals, or basically warns, let's say it signals really, the ends of the trend. Tells me where the trend is likely to either pause or reverse. And trends continue until they hit higher time frame supply or demand. So the problems that we're really having, like I said, as we're reaching up to new highs, not necessarily, maybe a little bit for the targets, but definitely figuring out where the end of this trend might be. Because as you can see, I'm looking at a daily chart of the S&P futures, and we have got a very strong uptrend that's been going on for quite some time, right? And the nice thing is the market tends to give us a bunch of warnings as to when the trends are getting weak or when they're possibly reversing. And there's a couple different ways of figuring out where the trends are stopping. We can do trend measurement. That's one thing. And basically, when we're looking at trend measurement, we're looking at strength or weakness. Obviously, weakness gives us that signal of potential change in the trend. And then we can also look for, well, again, we don't really have overhead supply, but we can do things like, why is it not going to the next line? It's weird. Oh, it did. And I spelled strength wrong. There we are. We can do things like project, and we have what are called Fibonacci projections. Now, it's not going to be as good as actual supply and demand, but if we are at all-time highs, we don't have anything else. So we can kind of project where possible turning points are likely to be in the markets. So when I'm looking at trend measurement, there's actually several different tools that we can use for that. One is simply looking at price. When you look at price and you kind of break it down, the size and color of the candles they offer clues to what the trend's doing. So obviously, if we've got a very strong uptrend, you should be seeing lots of green candles, and you should be seeing the size of those candles, not necessarily extremely large, but they should be medium size and continuing. And the same thing in a downtrend, you should be seeing mostly red candles. If you get interruptions with mixed colors in the candles, that could be a warning that the trend is getting a bit weaker. You see that in the uptrend, all green coming up, a little bit of red coming in, and even the size, look at how it shrunk down with those 3 candles before we got red. I'll zoom in a little more on this. Same thing here, big green candle, still mostly green, although we did get some weakness. Then the red creeps in and we're going sideways. It wasn't necessarily a reversal of the trend, but same thing, another move up, some small candles could try to continue, and then we got red. It just repeats itself. And now what we're seeing is a lot more red. And this is a little troubling too. Notice the size of the red candle compared to the other red candles around, and even the green candles before it. It's a very wide range. So that is what we call price shock. Let me move this text over so we can see that still. So price shock is basically a large candle opposite of the trend. It can happen in a downtrend as well with a large green candle. If we were to go back, say, to NASDAQ, and I'll look at weekly here, going way back in time here to 2008, 2007. So, and we can even go back further than that, but right here, 2006, you've got green candles, but then you start seeing some price shocks. Even as early as 2004, you see that big red candle. And if we pull this back, so that's the first candle you see off the right-hand side, you can tell, okay, we've got kind of a okay, but not great trend because there's red sprinkling in. Now we got the green coming in, and it's getting bigger with candles. So that's stronger, little weakness, strength again, now some weakness, and there's the price shock. And when you get price shock, that could be a warning sign about your trend being, kind of weak. Doesn't necessarily mean you're going to get a reversal. In this case, it did a pretty good pullback. You can see we followed through for a while and then continued to go back up. And this is what, 2005 now? In 2006, we saw some more of those. That, I wouldn't call that price shock. It's still smaller than this one. But right there, that's a problem. Notice the large size candle in January 2006. Again, it's red when we're in an uptrend. So there's some trouble with the trend, not necessarily reversing. And one more right there, again, big price shock. And that is warning that there's likely to be a move to the downside. Sure enough, it followed through to the downside. And then finally, we get all the way up here again. We got a few of them together right here. And it's 2006, actually 2007 is what I was looking for, I think. There it is. Another big price shock in February of 2007. And the trend is in trouble. Notice the red and green candles mixed, small candles, again, alternating in colors. And we're barely creeping higher. And one more price shock. Pretty good size pullback. Another big one. That's actually one of the biggest, I think, in the entire sequence. So far, all of those price shocks just led to some pullbacks. Okay. And this works, by the way, on any time frame. When you're looking at trends and you see something like that price shock, there are other things you possibly want to look to kind of confirm what's going on, but it is a warning sign that there is trouble with the trend. Just plain and simple. Even as the price was moving downwards, right here, red, 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 red. Now all of a sudden you got a big green candle. Well, we're probably not going to be able to continue down if you see lots of buying pressure, not to mention the wick on that red candle had lots of buying pressure. Remember, where we close in relationship to the highs and lows also tells you if you've got bullish or bearish pressure. And in this case, yes, it was a red candle, but it had a lot of buying pressure because we could not close at that low. So we get that big price shock candle there. And the next thing you know, we're in the bear market. Well, in that bear market, again, looking for reversals, wasn't really a price shock there. It was a kind of a smaller candle. But notice all the green candles coming together now. The trend is trying to, once more, turn around. Even as we were moving down, mixed colors, that's trend weakness before we reverse. So often we get warning signs before trend change. So we go to current price right now. Let me clean this up as well. Just doing some other notations for something. There's remove drawings. There we go. Anyway, you can see that we have a strong trend, little interruption. I would not call that a price shock. It's too small. Maybe a little bit. The range is a bit larger than most of these candles, except for the first one there. Interesting. So maybe there is some warning there. The current weekly candle is bearish, but once again, we still have bullish pressure. We haven't closed at or near that low. So overall, still relatively bullish. And we could break this down into daily as well. And you can see the trend weakness. And let's go to the specific contract now instead, because we'll get some better data. And maybe it's about the same. But once more, we're getting mixed colors in the candles, aren't we? So there is warning of trend weakness, but it doesn't necessarily mean we're going to immediately reverse trends. So I'll go back to, is that right? Yeah. There we are with my notations there. So that's a little bit about price shock. And yeah, you could actually use this, like I said, on different securities. Actually, let's take a look at maybe Tesla. And we'll do 15-minute time frame, just random, doesn't matter. And there is one. Look at that. Prices were moving to the upside, mostly green through here, basically on the 15th going into today. But then, when is that? This morning, a big price shock, red candle. So that's warning of possible trend weakness or change. And with Tesla, well, we're not at all-time highs, but we're at recent highs. So it's very difficult to identify where the trend is going to possibly reverse, right? We're in the middle of a gap. and we don't have any overhead supply for a while, at least until we can possibly fill that gap. But the price shock is a warning sign that that strong bullish trend we were trying to develop, and it was still somewhat of a bullish trend, is getting weak. It tried to continue, failed to break out to a new high, and started pulling back. So that's one way of identifying possible trend weakness, is just, again, just looking at the candles. I also mentioned, when it comes to size, it should be shape as well. Size, shape. And the reason why I say shape is something I commented on earlier, the wicks. Okay, when it comes to the candles, the most important price, doesn't matter if you're looking at 5-minute candles or daily candles, the most important price is the close. And what we want to look at is, where is the close versus high and low? The further away you close from a high, you'll be left with a topping tail. And topping tails signify selling pressure, because we could not close at that high. We had an imbalance that pushed prices down. Either we had a lot of sellers coming in and driving the price down, or we had a lack of buying pressure and the sellers had to become aggressive and lower their ask to be able to get shares or whatever it may be sold. And vice versa. If we end up closing away from the lows, we would be left with a big bottom tail in a candle. Color doesn't matter in this case. Obviously, if it was green, it'd be more bullish. If it's red, it's more bearish, but it doesn't necessarily matter, because you could have a green candle with lots of selling pressure, or you could have a bullish candle that's red, the bottom tail. Sorry, I got distracted there for a moment. Lost my train of thought. I'm back. Anyway, so where's the close versus high and low? And you'll see that sometimes, not always, at turning points in the markets. As we look at the highs right here in the ES, you can see back on Monday, we were left with a topping tail. So pulling back, obviously we know the next day was a sell-off, and that's not always going to happen. But basically we see this topping tail on the candles. I make this a bit larger for us. And the question becomes, okay, well, are we going to follow through with that selling pressure? We were in a nice uptrend. It is interrupted right now with selling pressure. Is that selling pressure enough to turn prices in the other direction? Or is it simply just maybe some profit taking before another round of buying? Well, we have to wait and see, do we break the low or do we break the high of that candle? Going back just a little bit, there was a topping tail. And you can see we went sideways. So it was enough to only pause price for a period of time. We eventually broke upwards, paused, and continued upwards. So this was only a warning of basically a trend pause before it continued. Well, we look at where we are now. Next candle obviously opened very close to the low, tried to move up and collapsed. So there was definitely a lot of selling pressure and continued. This is a daily chart on the S&P futures, but it can be done, like I said, on any time frame, any security. And you're very welcome. So the question is, when you see something like this, is the trend over or is it not? Well, as I said before, we could also look for some other supporting not documentation, but evidence, some other supporting evidence. One thing by itself is not going to tell you necessarily. It's just a warning. But when you start seeing multiple sources of information all telling you the same thing, now you got a higher probability. So we'll talk about some of those other things that we can use. Well, right here, you can see we paused and came back up. Even though we did break the low, not the high, we did recover almost all of it, at least from the prior open to where we are now. We'll see if this finishes. And today we actually have bullish pressure. So like I was saying, you can do this on any time frame. I'll drop down to a 1 hour time frame on the same security. And, well, we had kind of a weak uptrend. You can see there's spurts where it's very strong. Then we get mixed colors. We go a bit sideways. And in that sideways move, there were some bottom tails. Kind of hinting at some strength. We had obviously a big topping tail there where we paused, but it was just a pause. You can see the buying pressure was coming back in, and eventually we went up again. Once more, we went up, got a red candle, but it's still buying pressure. That bottom tail is buying. So you would expect prices to continue up. There's a bit of a price shock on the 60-minute time frame. So make it easier, I'll do this. That's how, so you know what time frame I'm on. But anyway, you can see we started, getting that price shock. So there might be some weakness now coming in the trend. The question is the trend over? Well, kind of looks like it might be interrupted pretty deeply here. Got a continuation to the downside. But that first candle gave you a warning that there may be continuation down. And I'll show you some other hints that I use. Again, it's not just one thing. This is suggesting that price is getting ready to possibly collapse and change the trend, but there's something else that's telling me, before somebody asks, it's just the regular RSI. I don't use any averages or things like that. But what I do change is the upper and lower overbought, oversold numbers. I use 60 and 40 rather than the traditional 70, 30. Okay, but it's just a normal RSI set up with defaults, really, I guess. And it's how many periods does it show? Yeah, 14 periods based on the closing price. That's all. But like I said, the only real change I ever do with the RSI is changing the overbought to 60 and oversold to 40. And I read it differently. I read it as a momentum indicator, not as an oscillator on price. So this is telling me that we still have a lot of bullish pressure. And sure enough, we kind of held up and made another, oh, nope, there it broke down. So, and it actually signaled there as well. It's kind of hard to see with the arrow in the way, but right there on that candle, if I could zoom in, you can see we went below that 40 number that I was showing you, and it continued down. No, I just used the RSI, not the stochastic RSI. The stochastic RSI would probably use the measurements of stochastics, which is a smoothing, and that would slow down the signals you would get. But I'm not familiar with the stochastic RSI. Oh, that one right there. Yeah, I'd have to take a look. But it's probably using a smoothing. Yeah, it's an indicator of the indicator. So again, when you do that, could be delaying your information and your signals. All indicators are delayed anyway. That's one of the problems. And the reason why they're all delayed is that signal that came in right here, for instance, where we broke below 40, that actually was not confirmed until the end of that candle. So there was no action that could have been taken on that signal until the next candle. Fortunately, that was small. But if it was another large candle, or even here, we also took a big price move before we actually got the bearish signal. And yes, overall, what I'm looking at is if RSI goes below 40, that's obviously bearish, because in a bullish trend, the RSI typically doesn't go below 40. And you see that looking back in this whole uptrend right there, that's where we really began. RSI never went below 40 on the pullbacks. And then if RSI goes above 60, that would be bullish. There's a crossing of the two lines stochastic RSI that gives you a signal in advance. I don't know about that. Like I said, it's impossible to give you a signal in advance because it would already move off of a low or off of a high by the time you got a signal. It's impossible for a technical indicator to give you a signal before the close of a candle. It might look like it's starting to cross, but it doesn't actually cross and confirm, and it can switch back before that happens. So right there, if I put in that indicator, for instance, that crossover right here, you can see it's on this candle, and that crossover doesn't actually occur until the close of that candle. So the action could not have been taken until the start of this candle away from the high. And when it crossed back over right here, same thing, it wouldn't have happened until, excuse me, well, they kind of laid on top of each other, but right there, they did a quick little crossover and then back below. So that would have been closing out the short, but it would happen on the next candle. So you always get those crossings or signals after the prices have moved away. There is one way of getting signals before that, okay? You don't do it until it's in the zone of 20 or 80. Well, this was above 80 in the crossover, but even still, it'll always be one candle late. So right here, for instance, okay, we had a sell signal, right? Kind of zoom in there. There's a sell signal above 80. It's at 90. So there's the crossing below. That's telling you to sell. And what happened? That wasn't good. Back here, let's see, that's below 20. And the buy signal, that crossing you see would not have really been visible until the end of that candle. So you would have been able to buy on the next candle. Again, it's off the low. So it is literally impossible for any indicator to give you a signal at the high or at the low, except for divergence. I've had to study, man, I've studied like 700 different technical indicators as a CMT. I had to go through all that, the testing. So I've had to actually break them down and study what they measure. And it's literally impossible because these are all set on the close. Now, if you set them on actual price inside of a candle, well, then you're going to get a lot of false signals. So it's a trade-off with indicators. You can either get really good signals late, or you can get a lot of false signals early. It's no in between. It's kind of weird. So the lines that I use on the RSI, I just use 60 and 40 rather than 70, 30. And that's right here why I do it. And it helps with the bullish trends or bearish trends. Now, what I was talking about with divergence, another warning signal you'll get for trends, the ones that were below and cross, I don't know. I don't use those. That was a stochastic RSI. It was a different indicator that I don't normally use. So I believe it was still set on whatever the default is. Yeah, 80-20, which is what's normal for stochastics. But anyway, what I was talking about is one of the better signals that you will actually see. For instance, here, we're coming up into an area where prices had reversed. So there's an imbalance there. There is obviously buyers interested in pushing prices up, but the sellers overwhelmed them and we reversed. So prices are approaching that area once more, okay? And as we're approaching that area, prices are moving up. We've got a lot of green, still looking good according to the candle color, right? You know, we'll just go ahead and enlarge this a little so we can see better. I still want to keep that there. There we go. So what other kind of warning could we get? Well, what about momentum? When prices are moving up, you should be getting more momentum, right? For prices to continue, you need momentum to continue. But if my indicator, in this case, the RSI, is signaling the momentum is not as strong as it was before, that is called divergence. Basically, just moving in the opposite direction. That's all. So what we have is what we call a negative divergence. Okay, with negative divergence, price is making new highs. But the indicator either makes the same or lower highs. Oops. And I'll fix that so we can actually see it. And respell it, or fix the spelling. So that is called negative divergence. And you notice that's happening as prices are hitting. But once again, it actually wouldn't confirm until the close of that candle. So it's always going to be a little late, but it's better than waiting for crossovers and everything else, because even if you're using traditional RSI at 70, that didn't cross over until this candle as we're moving away already. So let's see, using in conjunction with other signals. Okay, no, it's fine. Seems like if it's working for you, then you want to use it. That's fine. If something's working for you, I'm not going to, say don't use it. Obviously use it, but you just got to be careful. There may be better entries, and if you're giving up or taking on more risk than you need to necessarily, then you're taking on bigger losses. That's all. So just kind of re-examine things. And if, like I said, if it's working for you, by all means, go with it until it stops working for you, and then adjust your plan, reevaluate things. So anyway, right here, we had that negative divergence happening as we're approaching that prior turning point in the price. And sure enough, prices went down. So if we were to take that back to the NASDAQ, let's see, I'll use the current. And we were looking at big time frame daily, I believe. And actually, we'll go continuous and Q just to kind of look at that. So just going back randomly, right here, we have not the strongest trend, but it is a downtrend right there on the daily chart. We're getting mostly red. And remember, we have some weakness being shown with the mixed colors. Notice green, green, green being sprinkled in. If this were a very strong downtrend, that shouldn't be happening. And now what we're getting is an example. Oh, no, it's not yet. Let's see. There it is. Prices just made a new low. So this is the other type of divergence, negative. I'm sorry, positive. The other one was negative, we already talked about. This one is called positive divergence. And basically, positive divergence price makes lows, but the indicator makes higher lows or the same lows. Basically, again, this is measuring momentum. On this low, we had pretty good bearish momentum. As we tried to break down to a new low, we didn't have as much momentum. And that's a problem. You know, that's not always going to be a reversal necessarily of the trend. It could just be a pause in the trend as well. So you got to keep that in mind. Not everything leads to an absolute reversal. It could just be a pause. The difference would be what's happening with what we call supply and demand from the higher time frame. So right here, we have a positive divergence and prices start rallying. Look at all the green. And we broke out above 60. The bullish trend continues. And let's see, now we're in February 2024. No, sorry, 23 is the year behind. That's right, I went back in time. And notice we're making lower highs. We actually made possibly a lower low and we're losing momentum. So the trend is shifting. We've got red coming in. And we're still not getting below 40. So we don't have enough bearish momentum yet to really break down. And notice the green candles coming in again. That downtrend is very weak. It tried to start off strong with lots of red, but the green coming in and the fact we're not getting the momentum is telling us this may be turning again. And look at that. We went back up, but still no great trend, mixed colors. And finally, we got the green. Notice we made a lower low first, but now a higher high. We're not in an uptrend yet on this, and this is a daily chart. We're not in an uptrend because we don't have higher low and higher high, but we can't be in a downtrend, obviously, because we made a higher high. Well, trend is still trying to rally, still showing strength. And now weakness once again, movement sideways with mixed colors. So what does this mean for us now? Let's take a look. Again, I'll go to the current contract. Because at all-time highs, that's a couple things that we can look for. We can look to see what's going on with the shapes, colors, and sizes of the candles. And with the NASDAQ, we have a couple problems. We do have a price shock right there. We do see that prices were making new highs, but the indicator is showing a lack of momentum. That's a negative divergence. Now, does this mean we're going to change trends? No, it could just be a sideways pause before we continue to rally. The trend, technically, I think, is still up with the trend line. I guess we have a couple touches there. Let's see, does this extend all the way back? No, you can't cut through candles with trend lines, but I do have 1, 2, 3 touches right there. So the bullish trend is still up. And by the way, we're still bullish unless we can get below 40 on this RSI. That's typically when the trend is over. You can see since the rally started, which was what, October of last year? Yeah, end of October. That hasn't happened. We're still very bullish. So there's weakness, yes, but we're still bullish. And the candles, even the red one for this today, is bullish. It has a bottom tail. You know, you can look at smaller time frames like the 4-hour, same kind of warning signs, just on a different scale. That's all. So remove the drawings, we'll get it cleaned up here. And you can see, let's go back to Wednesday of, well, I guess that was in January. So right here, uptrend. And if we were breaking out to all-time highs, once again, we don't know where this is going to go. The only thing we can look at is what is our current trend and when is that getting weak? So a couple red candles and small size, that's definitely some weakness. You see we're losing some momentum. It's not a warning. That's not that big of a deal yet. No price shock or anything. Here we are now trying to break to a new high. And ooh, we're failing on momentum, aren't we? Well, that keeps popping things up. Nope, there we go. It followed through to the upside. Remember, I said that those are waiting for the close of the candles, but you can see we went to a new high and we got more momentum. For some reason, I can't get my numbers back over here that show me the actual scale. I don't know what's going on with that indicator. Okay. Again, topping tail on a candle, a little selling pressure, nothing to freak out about. Now we kind of confirmed bearish pressure is creeping in, but it's not very strong. It's mixed colors again. More selling pressure. And we start pulling back. Didn't go back into bearish territory, so we're still bullish overall. But look at all that selling coming in on those topping tails again. Like that is more selling pressure and warning that we might be getting ready to push downwards. You know, again, I go in detail in the RSI in my classes. If I look, I think it's here too. Is RSI on this one? Yeah, there it is. I have a whole video that I put together on RSI in pretty much every program I have, the E-mini think tank and the SPX cash flow. And then in the documents, should be there as well. Yeah, my RSI rules that I wrote up. So looking at that, I'm getting another warning sign. Oh, thank you. Stephanie said that video was very helpful. Yeah, the warning sign I'm getting is right there. We made a pivot high, but we failed to get above 60 when we're making that pivot high. Shows a lot of weakness in momentum, so that's likely to see new lows being made. Well, there's only one right there, and when we made that low, we still didn't get below 40, so we're more likely just going sideways at this point. Now we finally, again, right there, you can see pushing back up, closing back above 60, bullish trends back on, stalling out with small candles. And finally, here is a breakdown, it looks like. Yep, below 40. It's delayed. You know, it's late getting there and showing us, but once again, we did see the red candles and small bodies before it turned to the downside. And it continued down. Well, no, I didn't really give a signal there. Just waiting to see if there are any signals. Price shock, right? We were moving in a downward trend, mixed colors, price shock to the upside. So that's suggesting that prices are going to rally, and we close above 60. So new highs should be made. There we go. We actually broke out of the prior highs. And this is now in February. And basically, I look at this on a regular basis. I want to go back too far there. So this was Friday of last week, and then this Sunday, as we opened up, you could see prices tried to rally again. I don't think it was an all-time high, was it? I guess this was. So once again, all-time high. How do we know where we're supposed to be turning down? We're not in a bearish trend here. So we don't really want to go short, but we may want to protect our longs and tighten the stops. Why? Topping tails on the candles, more red than there is green, and the momentum is dying off while we were trying to make new highs. You can't sustain a move without the momentum behind you. And that momentum dying off, there's your negative divergence. Prices started pulling back quite a bit. Okay. Once again, big pullback. Now we're in bearish territory finally. Not in a bearish trend on this time frame. Okay, you got to remember the definitions of trends. For a bearish trend, we have to have lower highs followed by lower lows. The only thing we had here was a breakdown to new lows. And as we rally up, the big test will be, can we get through this area? That's the origin of a lot of selling pressure. And the question is, do we have momentum to get through? We have to get above 60, excuse me, to be able to break through that area. First test, couldn't do it. Now, look what's happening. Going into the zone, kind of probing through it. When that candle was above, it probably was above 60, but it ended up closing below. And obviously the zone's been violated, so now we can go through. Of course, as soon as we go through, oops, it pulled right back. That did not give any warning. Okay, looking at this, I would have expected that it's an uptrend at this point. Obviously, we have more green than red. We still have a few reds in there, so it's not the best uptrend, but there's really no warning. And this price shock comes out of nowhere, unfortunately. I mean, well, I guess you could argue that this was that turning point, but we were above 60. So I would have thought that it had a chance of going above. And sure enough, it pulled back, and that's where we are currently. So we are still bullish. Notice the pullback did not go below 40. So on the 4-hour time frame, the Nasdaq's still in an uptrend. If you were to draw out a trend line as well, oops, missed the right area there. Let's see, can I pull that back? Yeah. There we go. We're still in an uptrend. We have not violated that. But it's a very nervous uptrend right now. We've had a couple of price shocks to the downside. And typically when I'm trading intraday, I'm going to be looking at 60-minute trends. This is a 4-hour trend that might carry me through for a few days. Why is a 4-hour time frame? This is on futures. So futures are open almost 24 hours a day. But if I'm using this for stocks, for instance, if you're looking at QQQ, now we're looking at an ETF that's only trading for 6.5 hours, right? Between 9:30 to 4. So yes, I might use different time frames. I could possibly still use this 4-hour. And excuse me, what trend is telling me right now, and these tools are telling me right now, is that we basically try to rally up and close the gap, and we don't have enough momentum to continue to the upside. We're still bullish because we're above 40 and making higher lows, higher highs, but there is definitely a warning sign right now because we could not peak in price above 60. Let's see if we have another example of that happening before a drop. Yep, right here. Almost a similar situation where actually the drop is confirmed, or sorry, the peak is confirmed there. So what we have is prices trying to rally up, and we put in a price high, okay, and the high is defined with lower high and lower low on either side, okay, not a divergence because we made lower high in both price and the indicator. That's not a big deal. But what I'm seeing is we could not get a close above 60 on the RSI, and look what followed. Pretty good sized pullback. As a matter of fact, the confirmation for the bearish trend wasn't until there. Obviously we made lower high and lower low. The official bearish trend occurred there as we broke down to new low, lower high, lower low. But we also saw that break down below 60 or 40, excuse me, 40, and we continued down. So looking at current price, similar picture, trying to make another high, can't get above 60. Now, this would not be a bearish trend on the 4-hour time frame until we break that low, right? Lower high, lower low would be the trend, but that's a warning sign right now. The trend is pretty weak, although it's not too bad. You can see we have I guess we had a bullish candle there too. This one's red, and the previous one is green. It's very similar. So the question is that if this is the next move? Well, one more tool that I was going to refer to here, going back to ES where my notes are there. Got lots up there. Anyway, Fibonacci projections. That's another tool that we could use to project a move. And when I apply the Fibonacci projections, they're going to be applied to the trend time frame. Because that's what you're trying to do. You're trying to measure impulses and where the next impulse is likely to end and correct. Basically, prices are moving in sometimes, it's really just two different modes. We're either impulsing in the trend direction or we're correcting. And the reason why I was paused there for a moment is you can correct against the impulse or you can correct sideways. You don't necessarily have to move back. It could just be a sideways correction. So when you're in an impulse, typically you get bigger, faster, sharper moves and larger candles. So there's a bunch of impulses up. What is the letter G on that chart? Where is the letter G? Sorry. Trying to see where it is. Go back. You mean over here? Or I'm not sure where it was. Oh, on the last slide. Oh, I was on a different security. I think. I don't know. Yeah, these aren't slides. I'm looking at live charts. So I don't know if that was still on the NASDAQ or QQQ. And there's D's, which is dividends. That's what you're looking at on the bottom there. And then if you go to, if I did the continuous contract of the NASDAQ, there's little arrows. That's the rollover for the contracts. So I don't know. Anyway, going back here again, those are impulses up. And as I was saying, we have corrections in between them, which can either be down or sideways. So I'll use, let's see, that fuchsia for that. Oh, green G and lower. Huh. I didn't notice any green G. I didn't see it. Sorry. Not sure what it was for. So anyway, we have tools called Fibonacci's going all the way back to, what is it? The 1100s. Leonardo Pisano Fibonacci kind of discovered these, and he was, I mean, they've been around for even longer, but mathematically he found some numbers that pretty much define a lot of movements and sizes of things in life. And I'm not going to go in detail on all that if you want to. It was on the QQQ chart. Okay. Yeah, I don't know what it was. Sorry. I don't know what the G was. I didn't see it. It must have been something to do settings. I was on 240. I'm curious what it was, but I didn't see it. Yeah, I have no idea. Anyway, continuing on here, because I wanted to do this. We have two different types of Fibonacci's that we could use depending on which mode we're trying to measure. So we have what are called Fibonacci retracements, and those measure corrections. And then we have Fibonacci extensions, or sometimes called projections. Oh, that's what it is. Yeah. Grammarly. Yeah, I have Grammarly running on my program. So when I start typing text, that's what it is. You'll see that. Okay, that's what it is. Yeah, that's Grammarly to help with my English and typing. Okay. Yeah, that's all it was. It's just a program that I run in the background because I write a lot of text. And yeah, anyway, thank you, Trip. I appreciate it. Trip figured it out. Yeah, it's a separate program, just runs in the background on everything. Whenever I type, it tells me if I mistype something or my grammar is off. It's called Grammarly. It's just a program you could purchase right there. So if there's text as I'm typing, if I misspell things, it lets me know. If I'm using my punctuations improper, it lets me know, and I can correct things. So anyway, so we have projections, as I was saying, that measure the new impulse. So yeah, thank you, Trip. That's what it was, the green G. Like I said, if I, right here, do something like this. See, now it turns red. It's telling me I have a correction I have to make, and it even tells me where it is. It'll correct it for me. So right there, see more in Grammarly. I can do all that kind of stuff. Anyway, fortunately, it doesn't work too well. I mean, it doesn't have to work too much for me because I grew up with a mother that's an English teacher. So I speak good. Kidding. Anyway, we have these projections and measure new impulses. So if I'm looking at, let's say we're looking at the weekly trend, we can measure where the new, now you know what, I don't want to deal with this one. Let's go to the NASDAQ because I don't want to mess up this chart right now. We got all the text there. There we go. So on the NASDAQ, we can measure after a correction where the next turning point might end up, where the next correction might be, where the top of the market might be, if you will. So for instance, if we were trading on that daily chart, actually, no, it was this Zoom being brought to you by Grammarly. Exactly. Right here. Remember, we talked about the price shock going on right here on the 4-hour chart of the NASDAQ, or even the Qs. Doesn't matter which one, they're about the same. When I go to the trend time frame of the daily, I can look for the last impulse and try to measure where the next projection turning point is going to be for the next correction. And that seems like a lot. So first of all, right here, we had an impulse up, correction down, and this becomes a little bit of a judgment call as well. It becomes a little bit of an art rather than a science, because you have to figure out, okay, what is the actual impulse and where did the correction begin? Well, you notice I ignored a couple of red candles there, because to me, this was still moving up and then we corrected sideways. So I measured from the low to the high of the impulse and then the corrected bottom. And you see we have projections as to where we're likely to top out. And what happened at this previous area, red candle, overshot it a little, but overall, there was a correction there at the 0.618 of the previous impulse. The previous impulse then duplicated itself. You know what? Let's go, excuse me. Purple stands out. And if I clone that, it's the exact same size. You can see that from this low there, we made 100% a duplication of the previous impulse. And then right now, this peak was 1.272. So what happens is that these are the most common projections: 0.618, 1, 1.272, and 1.618. There are others, but they're not as common. So, and you want to see what works. Obviously, if it's not working, then it's maybe you drew it wrong, or it's just not respecting that. Remember, these Fibonacci projections are based on mathematical calculations. They have no, there's nobody sitting in the pits or directing price to say, hey, we got to stop here. But if enough people are looking at it, especially the big institutions, that's where prices are likely to pause and turn. So, and I can do multiple Fibonacci's as well. So this was based on that bottom move up from October and the first impulse. And you could see it respected those turning points. So this could be a pausing area. Again, we've got some weakness coming in trend in the NASDAQ where prices were trying to make new highs, but the momentum is not there. And we're at a fib level. Well, is this the top of the market or is it just a pause? We don't know. Technically, we're still in an uptrend, so it's just a pause until it's not. You know, if we were to go back, let's go back. Can I go to 2000? That's daily. I should probably go weekly for that. Oops, sorry, I wanted to look historically. There, we can go 2000. There we go. So once again, on a daily chart back in 2000, the tech bubble, I was living out in California and trading out there. Yeah, let's see, that seems about right. Impulse up, correction, although we could probably go from here. That's where it really began for the trend. It doesn't matter. And, oh, it's respecting the 100%. And look at that, we pause at 0.618. Wow, it kind of followed that, didn't it? We had the stop of the big move. We had a price shock. So the warning signs of the 2000 tech bubble was right here. You came up to the Fibonacci extension, 100% duplication of the previous move. There wasn't really any other warning other than red candles creeping in and now the price shock. And as we rallied up, we have less momentum. We're still above 60 though. And we're able to make a new high right there. Small candle, so there's some weakness. Fibonacci isn't really helping us. At that point, you would expect we might be going to the next measurement. And let's see, I'm not sure what the numbers are here. 6420. Well, that's a problem. prices are definitely making new highs, and we don't have the momentum supporting it, do we? Getting smaller candles, I'd be watching for a pullback, and there's another price shock. And now we tried to rally up, can't get above 60, and we pulled back more. Eventually going back up, and then look where it went. The Fibonacci measurement. Is that the peak? Nope, not done. It paused, pulled back, and went to the next fib level and beyond. And I think that's actually, it's after the crash right there. That was just the tech bubble back here. Now we're into a new impulse. So I know it wasn't. It's just another, yeah, I could have done another measurement, I guess. I don't want to keep going on the history and just take a look at what's going on currently. So let's remove that and refresh. We're running out of time here for the session, but you can see that we are hitting a measured move. And one of the things I want to look for when I use Fibonacci's is correlation. And what I mean by that is we can measure multiple impulses, and if they're lining up with Fibonacci extensions, that's the higher probability of where your price will turn. So again, I've got an impulse here that started, and we started correcting. And, you know, some people put it all the way at the top. Some people put it wherever the first correction began. I should probably go to the full top right there. Let's change the color. And actually need, there we go, 1.272. And this is pretty close. You can see there's overlap between those two. So both of them are pretty much in the same area. And even this was overlapping, and that was a correction point. So you've got two separate fib areas kind of correlating with each other, telling you that, yeah, this is where price is likely to correct. Again, we don't think or don't know if this is changing trend, but at least we have weakness at this area. Should be expecting a correction. And that's exactly what happened. And you could do this, like I said before, on different individual stocks. Let's take a look at Meta. And if I'm trading that intraday, I might be looking at a 60-minute time frame. We're at all-time highs again, right? Actually, let's go to daily. Since we're at all-time highs, and we'll clean this one up. Could almost go to weekly too, but let's, looking at daily, we're in a kind of chop right now. And once again, we're losing momentum. We have a negative divergence before see, that come out yet? No, that's the dividend coming out. Earnings came out, obviously. But we have a negative divergence, which is warning of trend weakness, right? Making new highs without the momentum. And let's see if Fibonacci would have helped. We got plenty of impulses here. If you ever wonder if it's, impulse or correction, you can always go to a line chart, and lines are based on the close. And sometimes it might help you. It's not as great here. You see overall move up, correction down, move up, correction, move up, correction. But sometimes the line charts will make it a little more obvious when you're looking, it'd probably be more obvious. Whoops. If I took out the price after this gap, let's fix it this way. Like that. Now you can see it moves. So again, impulse, correction. And this one wasn't that respected. This one did. And we'll try again with another. The next impulse up, correction down, and change the color. Once again, we get some red candles at those turning points, don't we? It was respecting that. And notice we've got two overlaps, 2.618, both of them right there. And I don't know if we had another impulse and correction here. I think this is our correction for this impulse. So that's it. So there's a negative divergence and a couple of Fibonacci targets at that area, warning that prices are likely to pause or turn in that area. So let's see. Going back, when you're dealing with all-time highs, that's pretty much what we've got. The overlap means it's a higher probability turning point when you've got multiple fibs lining up in the same area. And you can use different time frames perhaps even to see. I'll do that sometimes, but usually I'll look, and if we've got, like I said, impulse and correction and new impulse, Okay, then you can do the previous first impulse and the second impulse, and that's where you're looking for overlap, and those are higher probability turning points. So I do have, like I said before, in the educational videos, it's not in this one. I think it's in the E-mini think tank, more on the Fibonacci's. And I know Rob also did some special programs in Wealth Builders HQ for some of those Fibonacci's as well. But let me see, this E-mini think tank, because I have the most education in that program for sure, but I'm pretty sure I did a video on that. Bonus videos. Yep, E-mini Fibonacci, there it is. So I did a session on that, and I'm re-recording all the sessions. So if you join in the new E-mini think tank, you're going to be getting the fresh, brand new recordings that we're going to be doing on all the education stuff. So that's kind of cool too. And of course, like I said, with all the videos, there's also typically documentation that goes along with it to support that information. And the nice thing is I'm pretty open with my students. You know, if they ever need any help, they just message me. Obviously, there's live sessions. I do Q&A sessions too, where we interact, but there's also messaging that's always available too. So anyway, I got to run. That's it for me today on the online here. Hopefully I gave you some insights as to what to do when it comes to all-time highs. You basically look for the trend weakness and don't be so eager to rush into the bearish side. A lot of people thought, you know, looking at the market on a weekly basis here, that we were going to go into a bear market when we had this pullback in mid-2023. And you can see, yeah, it started getting pretty weak there and we pulled back, but we eventually rallied up again. And the markets will give you that warning. We actually had a price shock right there in October of 2023, warning of the change in the trend back to bullish. So keep an eye out for those warning signals. And if you've got more questions, you can always email us, support@wealthbuildershq.com. I'll see you again next time. So thanks for being